Assalamualaikum. We are from Group 1 and we are going to compare the financial analysis between Aeon, Berhad and Parkson Holdings. So, this is our best team member. We got Hafiz, Ikmal, Fahmi and me, which is Alif. We are going to move to introduction. Today, I will be giving a brief comparison between two major players in Malaysia retail sector, Aeon Berhad and Parkson Holdings Berhad. Aeon Berhad is part of Japan's renowned Aeon Group. It entered the Malaysian market in 1984 with its first store opening in Malacca. Over the years, Aeon has grown into a leading retail chain operating malls, supermarket and specialty stores nationwide. Aeon is known for being customer-focused, eco-friendly and community-oriented, reflecting traditional Japanese value in its operation. On the other hand, Parkson Holdings Berhad is a subsidiary of the Lion Group. It started operation in Malaysia a bit later in 1987. Parkson runs large format department stores offering a wide range of products from fashion to household goods. The brand primarily targets middle to upper income consumer and is well regarded for its product quality and customer service. In terms of business strategies, Aeon adopts a Japanese-style integrated retail concept. Usually operating within mall settings, it often partners with another tenants to create a complete shopping experience. Meanwhile, Parkson follows a more traditional departmental format, but with a strong focus on regional expansion into countries like Vietnam, Myanmar, and China. Its strategy revolves around brand diversity and providing affordable luxury, appealing to value-conscious customers. In summary, while Aeon focuses on community-based, more integrated approach, Parkson is leveraging regional growth and brand variety to stay competitive. Both companies contribute uniquely to shaping Malaysia's retail landscape.
Now, we will move into the financial analysis section of our report. There are four main types of financial ratios that we have analyzed for both Aeon Berhad and Parkson Holdings Berhad. The first one is liquidity ratios. This measures a company's ability to meet its short-term obligation using current assets such as cash, inventory or receivables. Second one is efficiency ratios. This assesses how effectively a company utilizes its assets to generate revenue. The third one is leverage ratio. This helps us understand a company's ability to meet long-term debt and financial obligation. The last one is profitability ratio. This indicates how efficiently a company generates profits relative to its revenue, assets or equity. Alright, now let's begin with the liquidity ratio. Between the two companies, Aeon Berhad appears to be less liquid than Parkson Holdings Berhad. Aeon's current ratio is 0.695, which means it does not have enough current assets to cover its short-term obligation. In contrast, Parkson's current ratio is 1.047, showing that it has sufficient assets to meet its short-term commitments. We can also look at the quick ratio, which excludes inventory to assess liquidity. Aeon's quick ratio is only 0.295, while Parkson is much higher at 0.897. This means that without inventory, Aeon has even fewer liquid assets to cover its immediate debts, while Parkson is in a better position. Overall, this shows that Aeon is more vulnerable to short-term financial distress. To improve its liquidity, Aeon may need to reduce its inventory levels, accelerate its customer payments, or convert some short-term debt into long-term debt to ease pressure on its short-term resources. Next, let's take a look at one of the most important measures in working capital management, which is the cash conversion cycle, or we call it CCC. The cash conversion cycle shows how quickly a company can convert its investment in inventory and receivable into cash. In other words, how fast a business collects money after spending on stock. For Aeon Berhad, the CCC is 73.33 days. Is negative 73.33 days. This means that on average, Aeon receives cash from customer more than 73 days before it has to pay its supplier. A negative CCC like this reflects strong working capital management supported by fast inventory turnover, short collection periods, and extended payment terms with suppliers. Meanwhile, Parkson Holdings Berhad record an even lower CCC of negative 157.91 days. At first glance, this might seem even better, but when we look deeper, we find that this figure is mainly driven by Parkson's very long average payment period of 333 days. This means Parkson takes a significantly longer time to pay its supplier, which could be a sign of over-reliance on credit or possibly delayed payments due to weak liquidity. While both firms benefit from a negative CCC, which indicates faster cash recovery, Aeon's shorter SCP and ICP shows that it has a more efficient and balanced cycle. In contrast, Parkson's negative CCC may raise concerns, as it's largely dependent on stretching supplier payments rather than operational efficiency. Now, let's move to the efficiency ratio. Efficiency ratio helps us to evaluate how well a company utilizes its assets and manage its operation to generate revenue. In this area, Aeon Co Berhad clearly outperformed Parkson Holding Berhad across all the major ratios. Alright, to begin with, Aeon's inventory turnover ratio is 4.652, which means it sells and replaces its inventory more frequently than Parkson, whose ITR is only 3.682. This indicates that Aeon has better inventory control and a shorter selling cycle. Looking at the average collection period, Aeon again shows a clear advantage with an SCP of just 5.158 days compared to Parkson 76.26 days. This tells us that Aeon collects payment from customers much faster, helping maintain a healthier and more stable cash flow. In terms of receivable turnover, Aeon has a ratio of 70.76, which is significantly higher than Parkson 4.786. This highlights Aeon's strong credit sales management and effectiveness in collecting receivables. Asset utilization is also stronger for Aeon. The fixed asset turnover, or we call it FATO, is 0.933 compared to Parkson 0.469, showing that Aeon is able to generate nearly twice as much revenue per ringgit of fixed asset. Lastly, Aeon's total asset turnover, or we call it TATO, is 0.7563, again much higher than Parkson, 0.337, indicating that Aeon is using its total assets more effectively to drive sales. In summary, Aeon outperforms Parkson in all aspects of efficiency. It has better control over its inventory, faster collection of receivable, and more productive use of both fixed and total assets. Parkson, on the other hand, may need to rethink its operational approach, particularly in how it manages asset usage and cash conversion from operation.
Let's take a look at the leverage ratio. Parkson Holdings Berhad has a higher debt ratio of 0.738, meaning 74% of its assets are financed through debt. This suggests a greater financial risk as the company depends heavily on borrowed funds and face higher pressure to meet interest payments. In contrast, Aeon Co Berhad has a lower debt ratio, which is 0.656, indicating a more balanced financing structure. Looking at the debt to equity ratio, Parkson stands at 2.823, while Aeon is at 1.909. This means Parkson uses RM 2.82% of debt for every other RM 1 ringgit of equity, showing a heavier reliance on debt compared to Aeon. Furthermore, the interest cover ratio, which measures a firm's ability to meet its interest obligations, is negative 0.212 for Parkson's, indicating it cannot cover its interest expense. Meanwhile, Aeon's ratio is 1.339, showing it earns over 1.3 times more than what it needs to pay in interest. In summary, Aeon Co Berhad demonstrates stronger financial stability and lower risk compared to Parkson Holdings Berhad due to its healthier balance between debt and equity and its better ability to meet interest obligations.
Next, the profitability ratio analysis for Aeon Co Berhad and Parkson Holdings Berhad. Profitability ratios help us measure how efficiently a company generates profit from its revenue, assets, and equity. In this analysis, we focus on 5 key ratios: gross profit margin, operating profit margin, net profit margin, return on asset, and return on equity. So, let's start with gross profit margin. Parkson has a higher gross profit margin of 56.2% compared to Aeon's 33%. This means Parkson makes more profit after deducting cost of goods sold. However, that's where Parkson's advantage ends. For the operating profit margin, Aeon recorded 6.91%, while Parkson is slightly higher at 10.29%. But here's the catch: when it comes to net profit margin, Aeon is positive at 3%, while Parkson is at negative 4.5%. This shows Parkson is losing money after all expenses are considered. Looking at ROA and ROE, Aeon again outperforms. Aeon's ROA is 2.27% and its ROE is 6.61%, meaning it's generating good returns from both its assets and shareholders' equity. In contrast, Parkson recorded negative values for both ROA at negative 1.53% and ROE at negative 5.85%, showing inefficient use of its resources and investors' funds. Although Parkson has a strong gross margin, Aeon is clearly the more profitable company overall. It's generating positive returns, managing its expenses better, and using its assets and equity more effectively.
To conclude our financial analysis, let's take a quick look at the SWOT analysis for both Aeon Co Berhad and Parkson Holding Berhad. Starting with Aeon, the strength is Aeon shows strong operational efficiency with high inventory and receivable turnover. It also records positive profitability and a healthy interest coverage ratio. Its negative cash conversion cycle reflects solid working capital management. Alright, for the weaknesses, however, Aeon's liquidity is weak. With a current ratio below 1, it may struggle to meet short-term obligation if pressured. It also heavily depends on long payment terms to suppliers. Alright, move to opportunities. Aeon can improve its liquidity by accelerating customer collection and reducing inventory levels. There are also great potential in expanding its digital and e-commerce channels. Alright, for the last one, for the threats, rising competition and economic uncertainty may affect its retail margin. Any change in supplier credit terms could also impact its cash flow. Alright, now for Parkson Holdings Berhad, its strength is Parkson has a high gross profit margin and benefits from very long payment terms, which help preserve cash in the short term. For the weaknesses, it faces a significant issue with efficiency, profitability, and debt. Its poor asset turnover, long collection period, and inability to cover interest expense raise red flags. Alright, for the opportunities, Parkson can restructure its operation, improve receivable collection, and adopt digital strategies to modernize its retail models. Alright, for the last one, for the threats, Parkson is exposed to high financial risks due to over-dependence on debt and extended supplier credit. A shrinking department store market also poses a long-term threat. In short, Aeon is more efficient and profitable overall, while Parkson needs to address serious operational and financial challenge to stay competitive.
Alright, we move on to the financial statement of both companies. For the year ended 31 December 2024, Aeon reported total non-current asset of 4.57 billion, while total current assets stood at 1.07 billion. This brings the company's total asset to Rm 5.63 billion. On the equity and liability side, Aeon recorded total equity of 1.94 billion. Its non-current liabilities amounted to 2.16 billion and current liabilities total 1.54 billion. Overall, Aeon total liabilities were 3.7 billion. In terms of profitability, Aeon generated total revenue of 4.36 billion in 2024. Its total expenses were recorded at 4.06 billion. The company achieved a profit from operations amounting to 294.6 million and a profit before tax 207.8 million. After accounting for tax, the net profit for the year was 128 million. Aeon also recorded total comprehensive income of 134.4 million. Basic earnings per share stood at 9.12 cents. For Parkson Holding Berhad, the total non-current assets as of 31 December 2024 amounted to 5.9
billion, while current assets were 2.34 billion. The company's total assets were significantly higher than Aeon's, standing at 8.32 billion. Parkson's total equity was recorded at 2.18 billion. Its non-current liabilities reached 3.19 billion, while current liabilities amounted at 2.24 billion. In total, Parkson's liabilities were 6.14 billion. During the financial year 2024, Parkson reported total revenue of 3.15 billion. Total expenses for the year were 2.73 billion, and the company recorded a strong operating profit of 415.8 million. However, due to high finance and impairment costs, it ended with a loss before tax of 72.2 million and a net loss after tax of 127.2 million. Parkson's total comprehensive loss was 227.4 million, and its basic per share was negative 8.88 cents.
The conclusion of our company analysis between Aeon Co Berhad and Parkson Holdings Berhad, focusing on three key questions. First question, what is the general financial condition of both companies? Overall, Aeon is financially stronger. It recorded a positive net profit margin of 3%, ROA of 2.27% and ROE of 6.61%. This shows the company is profitable and manages its resources well. It's also efficient in operations with high inventory and receivables turnover. However, its liquidity is a concern with a current ratio of only 0.695. Parkson, meanwhile, shows weaker financial health. Despite a strong gross profit margin of 56.2%, it's making losses with a negative net profit margin of negative 4.5% and negative ROA and ROE. Its high debt levels and negative interest coverage ratio also indicate high financial risk. Second question, can these companies grow and be more efficient in future? Aeon has good potential for future growth. Its current profitability and efficiency provide a solid base for expansion, especially if it improves its short-term liquidity. Aeon is also well positioned to grow through digital retail strategies. Parkson, on the other hand, face challenges. With consistent losses and weak efficiency, its future growth is uncertain unless major changes are made. Third question, which company is worth recommending to the Board of Directors, BOD? We recommend investing in Aeon Co Berhad. It's clearly the better option in terms of profitability, efficiency, and financial stability. Despite its liquidity weakness, Aeon is more sustainable and reliable for long-term investment. Parkson's high debt and consistent losses make it a risky choice. To conclude, this assignment help us apply financial analysis to real companies and identify how key ratios reflect business health. Aeon is the stronger company and a more attractive investment in Malaysia's retail sector. That's all from us. Thank you very much.